Good morning, students. This is the second part of the seminar on international trade. First part, I discuss some important concepts in the international trade and past question papers relating to the selected areas. Let's look at the second part of the seminar. Here, I'm going to discuss a very important area of the international trade, exchange rate. You better take down this topic. Take it down. Write it down. Exchange rate. You know, there are different types of markets in the economy. Markets, we have commodity market, factor market, money market, foreign currency market. Those are the main markets we have, right? Commodity market, factor market, money market, foreign currency market. In each market, something is traded. Now, when goods and services or other stuff are traded in the market, there are two parties, buyers and sellers. The main purpose of market is to exchange goods and services. But before you exchange goods and services or any other stuff in the market, we have to decide the price and the quantity. It is the first function, determination of price and the quantity. As I told you earlier, we have four markets. Commodity market, there are buyers and sellers. Price is commodity price. Factor market, there are buyers and sellers. Factor price is the price at which factors are traded. When you come to money market, the price is interest rate. And exchange rate is the price of foreign currency market. Now we are going to talk about the foreign currency and exchange rate. So simply, the exchange rate is the price of foreign currency market. What is foreign currency market? When you purchase goods and services from another country, or when you sell goods and services to another country in exports and imports, we receive foreign currency. And when we sell goods to another country, we receive foreign currency. When we make a payment, we have to pay in their currencies. So this is the basic situation where you come across foreign currency. So what do you mean by exchange rate? Exchange rate, as I told you earlier, it is price of the foreign currency market. But foreign currency, just assume that you have amount of money, Sri Lankan rupees, right? You bring this money and purchase foreign currency. So then rate is determined. It is the rate at which one currency is exchanged with the other. Let's say you are going to purchase dollars, USDs, American dollars, right? So then how much money, how much rupees you pay to purchase $1? That is the basic meaning of exchange rate. The price of one currency in terms of the other. Take it down. Price of one currency in terms of the other. Or you can say it is the rate at which one currency is exchanged with the other. Right. You can express this exchange rate in two different ways. There are two ways. We call them direct method and indirect method. What do you call direct method? The easiest one, direct method. In Sri Lanka, we use direct method. Under the direct method, you express the exchange rate in terms of your currency, local currency. Now, $1 is this much rupees. £1 is this much rupees, right? So likewise, you explain or express, you calculate the foreign currency in terms of local currency. That is called direct quotation method. Remember the name, direct quotation method. What do you mean by direct quotation method then? That is expressing the foreign currency or the exchange rate in terms of the local currency. 300 rupees equal $1 or $1 equals 300 rupees. We express in terms of our currency. The second method, indirect method. Indirect method, you express the value of currency in terms of foreign currency. In terms of foreign currency. Now, in my example, give me 1 second, I'll show you. Right. Foreign currency, foreign exchange rate. Direct quotation method. I just put DM, direct method, indirect method. Just for that purpose. $1 equals 300 rupees. Yeah, 300 rupees. Here, 1 rupee equals how much? 0.0033 dollars. Right? Under the direct quotation method, you express the exchange rate in terms of your currency. How much is the value of a dollar? Then 300 rupees, for example. Under the indirect quotation method, we express the value in terms of foreign currency. 1 rupee equals 0.0033 dollars. I hope you understood it. Now, the next important thing, how do you decide this rate? In the determination of exchange rate, we come across 3 concepts, three basic methods of determination of exchange rate. Or you can sometimes call them types of exchange rates. There are different types, but based on the determination of the exchange rate, there are 3 types, especially according to your study text. I always explain the concept to align with the study text details. There are 2 methods. A fixed exchange rate system and floating exchange rate system. What is this fixed exchange rate system and the floating exchange rate system? There is a combination of these 2. Practically, we can't exactly apply fixed exchange rate system or the floating exchange rate system, though we call it floating rate, but the central bank in Sri Lanka involves to determine the final rate, right? But theoretically or for the study purpose, we have 2 systems, fixed exchange rate system and the floating exchange rate system. Usually in your question paper, they test these 2 areas. But whatever the method you have, right, fixed exchange rate system or the floating exchange rate system, you should know how to decide the exchange rate. Simply, like other markets, exchange rate is determined demand for foreign currency and supply of foreign currency. Then I have a question. What are the reasons for demand for foreign currency? Why do Sri Lankans demand for foreign currency? Foreign currencies are demanded where we make a payment to another country. Simply, you never forget this one, imports, right? Understand the whole concept, the easy ones, right? Through easy ones. Imports. When you purchase good from another country, you have to make the payment in their currency. Therefore, you have to buy foreign currency or you have to demand foreign currency. Then if I just draw you the demand curve, look. Dollar rupee rate. Here dollars you are going to purchase. Now this is the demand curve, like normal demand curve. High price, low quantity, right? When you buy, let's say $1 equals 450 rupees, then you buy less quantity, Q1. But if your rate is low rate, like $1 equals 200 rupees. Then you have to pay only 200 to purchase $1. You buy more dollars. This is the demand curve for foreign currency. Then foreign currencies are demanded to purchase goods and services from the outside. What are the situations? Imports. You have to make for import of goods. You have to make for payments of services. And you have to send money to another person. And you invest money in other countries. Or you pay factor payments like interest payment or profit remittance. So in all these situations, we need foreign currency, demand for foreign currency. Then supply of foreign currency. Supply of foreign currency, to understand the idea of that, is little difficult compared to this part. Why? Because foreign currency, in your foreign currency market, you should first earn foreign currency. What I'll tell you is, you have to understand supply of foreign currency in terms of the sources that you have or you receive foreign currency. Let's say exports. When you export goods to another country or when you provide a service to another country, you receive foreign currency, right? That is supply because you receive foreign currency to supply. Then foreign currency supply depends on what? Depends on the money you receive in other countries. Then supply is determined by especially export. When foreigners invest in our country, there is a supply of foreign currency. When we receive money for our export, there is a supply of foreign currency. Now, foreign currency supply curve, look, behave other way around. You are selling foreign currency. Just assume that you are selling foreign currency. You are not purchasing foreign currency. Now you are selling. How do you sell? Low price, then low quantity. High price, high quantity. This is the supply curve. Simply. right? Think of the various ways that you can receive money from another country to our country, right? Okay. Now you know demand for foreign currency and supply of foreign currency. With this basic knowledge, let's look at how to determine the exchange rate or how to determine the price of the foreign currency market. Demand curve and supply curve. Look, there are different prices, different quantities. But finally, the final exchange rate is determined by demand and supply. Demand for foreign currency, supply of foreign currency. Just assume this, right? Let's say 3,000 rupees. Say Q quantity. This is our final rate. Then exchange rate is determined by demand for foreign currency and supply of foreign currency. Now we can understand two basic systems, fixed exchange rate system and the floating exchange rate system with this knowledge. Whatever the system you apply, under the general system, the exchange rate is determined in the foreign currency market with demand and supply. Now, what is floating exchange rate system? Under the floating exchange rate system, exchange rate is determined by demand for foreign currency and supply of foreign currency. Very simple. Can easily explain it. What do you mean by floating exchange rate system? This is the exchange rate system in which the exchange rate is determined demand for foreign currency and supply of foreign currency. Clear? Right. $1 equals 300 rupees. This is a floating exchange rate system. Then what do you mean by fixed exchange rate system? Under the fixed exchange rate system, financial authorities, now in Sri Lanka, central bank. Central bank involves and intervene to the market and determine the rate. But according to demand and supply of foreign currency, the rate is $1 equals 300 rupees. Now, artificial rate is determined by the central bank. So that is called fixed exchange rate system. Here you can easily understand, the rate according to the demand and supply, $1 equals 300. But when you decide a fixed rate, it would be above 300 or below 300. It's artificial rate. Or you undervalue your currency in terms of foreign currency or overvalue your currency. Then if someone asks you to show the fixed exchange rate system graphically, this is the way you show it. $1 equals 250 rupees. This is fixed exchange rate. Clear? Right. Now you do. I'll repeat. Under the floating exchange rate system, the exchange rate is determined by demand for foreign currency and supply of foreign currency. Demand for foreign currency and supply of foreign currency of the market. It is the real rate. It is the real value of your currency in terms of foreign currency. But under the fixed exchange rate system, financial authorities involves into the market and decide the rate. That is an artificial rate. In order to maintain this fixed exchange rate system, central bank should have enough foreign reserves because there is excess supply and excess demand where you disturb the general process and create artificial rate. Right. Let's look at certain advantages and disadvantages. In your question paper, they usually test this one. What are the advantages of floating rate system? What are the advantages of fixed exchange rate system? Let's look at fixed exchange rate system. Now, fixed exchange rate system, it is a fixed rate. The name itself gives you idea. It's a fixed rate. When you make economic decision, so you know that the rate is fixed, then you can make your economic decisions very easily. But it doesn't mean that you have favorable economic system in the country, but you have favorable or unfavorable situation. But you can make economic decisions without fluctuations. That's good. And you can make this artificial rate in a way that you get benefit to the country. That advantage you have. Sometimes you can select particular industry, or you can select particular stakeholders of the foreign currency market, and you can motivate them with the fixed exchange rate system. And fixed exchange rate system is considered as a kind of solution for the foreign currency problems of the country. So we have advantages. You can look at the book. There are advantages and disadvantages of these two systems. You can read it. Then, what are the disadvantages of the fixed exchange rate system? Apparently, you can see it is not the real rate. It is not the real rate of your currency. You undervalue or overvalue. There is undervaluation or overvaluation of the currency under the fixed exchange rate system. And having a fixed exchange rate system of the country indicates that you have exchange rate problems or foreign currency problem in the country. You know, even in personal life, more rules and regulations, right? Your home, if you have more rules and regulations, it indicates that you have problem. Because when the foreigners or the other countries analyze exchange rate system of the country, if they come across fixed exchange rate system, right? But it doesn't mean that you have always problems with the fixed exchange rate system, but usually fixed exchange rate system indicates that you have foreign currency problems of the country. It is the solution for that, right? And you know, as I explained you earlier, the value of foreign currency, the value for exchange rate, our currency, in terms of the foreign currency, our currency value depends on demand and supply. If you export more, you have favorable exchange rate. Without increasing export, if you import a lot of goods to the country, or if you increase your payment made by a country to another country or the rest of the world, what happens? Your currency value declines. Let's assume that you have fixed exchange rate system. But there are so many good things are happening, or favorable changes are happening in the economy to increase our export. But if you have fixed exchange rate system in the country, though you motivate people to increase export, it is not affected the exchange rate. The exchange rate is not affected. Why? It is fixed, right? But if you have a floating system, you can change your rate according to the motivation, right? So you reduce imports, you increase export, you encourage exporters. So as a result, you can make a favorable rate. Then your rate is sensitive to the changes in the business environment or the economic environment. I hope you understood. Right. And some advantages of the floating exchange rate is now disadvantages and advantages you can just learn. And the floating exchange rate system, the real rate is determined. It is the actual value of the currency, right? And when you encourage export, you can make a favorable rate. You can change your exchange rate in a favorable manner to get more benefit to the country. And if there is a requirement to change your exchange rate, you can use your export, imports, and economic variable in a proper manner, right? When you change your economic behavior or the policies, your exchange rate is determined, or exchange rate is affected by the policies. So those are some advantages. But without taking much time on advantages and disadvantages, I will bring you another important point of this topic. Devaluation of currency and appreciation of currency. Especially, look, just take down, explain the difference between devaluation and depreciation of foreign currency, exchange rate. Right. Now look at this. You better draw these two curves with me. This is your supply curve for foreign currency, demand curve. Supply, then demand. General situation. Assume that here dollar rupee rate, here dollars. Right, just assume it. All right. Now your rate, $1 equals 300 rupees. $1 equals 300 rupees. Right, this is the rate. Assume that this is diagram A. This is B. Now I'm going to talk about two concepts: depreciation of exchange rate and devaluation of exchange rate. Now, depreciation of exchange rate or appreciation or depreciation. Depreciation means decrease in value. Appreciation means increase in value. Remember, my students, appreciation or depreciation are relevant where you have floating exchange rate system, right? Financial authorities does not involve in determining, or they do not influence on the exchange rate. So then how do you define the depreciation of exchange rate? That is decrease in value of currency as a result of decrease in demand or increase in demand or decrease in supply of foreign currency. I'll repeat. That is decrease in value of currency. Now we are talking about rupees, right? Value of rupee declines in terms of foreign currency. Value declines as a result of increase in demand for foreign currency or decrease in supply of foreign currency. I'll show you the situation. Increase in demand for foreign currency. Increase in demand for foreign currency. Increase in demand for foreign currency. I don't show the supply side, otherwise like confused with so many lines. Look. Now the rate, $1 equals 500 rupees. Remember, my students, 500 now, you receive 500 rupees, it is It doesn't mean that the value of our currency has been increased. No, value has been decreased. Earlier, you paid only 300 rupees to purchase $1. Now you have to pay 500 rupees. It means your currency or the Sri Lankan rupee, the value has been decreased. Now, this is the way you show depreciation of foreign currency, exchange rate, depreciation of your exchange rate, value of your currency. Then what is devaluation? Now, depreciation is an automatic process. It is determined by demand for foreign currency and supply of foreign currency. Let's say we buy more imports, right? We pay more loans, right? We pay more interest to other countries, and we pay we give profit dividends to foreigners. So then we have to buy more for foreign currency. Then our demand curve shift to the right. Now you can see. Look at my diagram A. The value of currency declines. Earlier we paid 300, now we pay 500. Now look at the devaluation. And devaluation is applied, or devaluation occurs where we have fixed exchange rate system. Now very clear. The depreciation happens, or depreciation is created, or it is emerged because under the floating exchange rate system. But devaluation, it is not the automatic process. You purposely bring down the value of currency. How do you purposely bring down? Now, same result, look. Under the normal rate, it was 300. Now, you purposely bring down $1 equals 500 rupees. This is called devaluation. Now, see the difference of my illustrations. Under the devaluation, how do you do that? Under the fixed exchange rate system, the financial authority bring down the value of currency. They bring down the value of currency. They reduce the value purposely, right? Then you have to pay more rupees. Now you have a problem. Why do we purposely, now we always try to improve our exchange rate or increase our value of currency, right? But why do you purposely bring down it? There are certain situations. That is very important, right? Devaluation is done for special purposes, right? When you devalue your currency, what happens? You discourage imports, right? Why? Earlier you paid 300 to purchase $1 product. Now how much you pay? 500 rupees. Then importers think, oh, I had to pay 500, then I decrease my imports. Then in order to discourage imports, you devalue your currency. Devaluation, right? And what happened to export? When we reduce our value in terms of one currency, the value of that particular currency will increase. Then they have to pay less amount of their currency to purchase our currency. Simply, export prices decline. Export prices decline. Or you can say export goods are cheaper than previous prices. What happened? Export demand will increase. That is the purpose. So simply, there are two purposes of devaluation. What do you mean by devaluation? You reduce the value of currency, of our currency in terms of foreign currency, for two purposes. Encourage exports, you better take it down, and discourage imports. Okay, student, please draw these two diagrams. Take a little time, like 1 minute. There is another important point that you have to study regarding devaluation. Devaluation, now, you know, we decrease the value of our currency in terms of foreign currency. But there are certain conditions to be satisfied to succeed the devaluation. Now, what we did, now simply we did, now we increase our import prices. Then look at the reaction of the market. If you have essential imports, if importers do not care about the price change or the exchange rate and buy or purchase or import the same quantity to the country, what happened? Your purpose was to discourage imports, but they purchase the same quantity even after the devaluation. Then you can't succeed that. Therefore, there should be elastic import demand. Elastic means when price increases, import should be decreased. That is one condition. Elastic demand for imports. That is number one requirement. Take it down. Elastic demand for imports. How about the export? Now, our goods are cheaper than other goods comparatively, other goods after the devaluation. Then we should assume that foreigners buy more export from our country. They purchase more. Then there should be elastic demand for export. Second one, elastic demand. When price decline, they buy more. Elastic demand for export. Simply they purchase more after the price change. Then you are okay. Third one, though they demand, if we can't supply, what happens? Export, you have two parts, two ends. One, there should be good demand for export. Other side, we should have enough goods to supply. Then export supply. Even export supply should increase. Then elastic export supply. Now very simple, all three are elastic part. Elastic import demand. Elastic export supply. Elastic export demand. Those are the three situations. In addition to that, fourth one, there should be a favorable inflationary situation in the country. Like if you have high inflation in the country, you can't succeed with the devaluation. I think devaluation, the test, let me see some questions, past questions. Give me 1 second. If your value of currency declines, what happened? You have to pay more, or your import prices increase, and we have to pay more loan interest, loan settlement, installment, and there is a possibility, high possibility to increase the inflation of the country. Import prices are very high, right? And you have to borrow more loans. Then there is unfavorable situation in the BOP. Give me a second, I'll show you. Yeah, 2020 question paper. Without sharing this, I will. No, I'll share the whole screen. Yes, better. Yes. (2020) paper, July. Question number 5. Now, question number 6. State 4 advantages of international trade. Explain the difference between fixed exchange rate and flexible or floating exchange rate. Remember, my students, flexible, floating, both are same. Fixed exchange rate system and the floating exchange rate system. Even you can draw diagram. Even without that, you get marks. So 3 marks. Let's see another question. 2021. 2021. 2021 January. Advantages, state 2 advantages of international trade. Very easy. 2 advantages. And advantages of protectionism, I didn't discuss that. Protectionism, let's see that. Now see part C of this question. Explain 3 consequences of devaluation of Sri Lankan rupee against USD. Consequences. If you devalue your currency, your import prices increase. You have to pay more. And your loan interest, loan repayment, then it will result an inflation of the country. We have to go for more loan facilities, devaluation, right? And your export income increases. So likewise, you can write a very good answer. The answers are available. I don't take time to show you the answer, right? Devaluation. Let's look at another question. 21 July. 21 July. Check whether you have another question from this part. Question number 5. 5, you don't have. This is a country controls imports by tariff. That is protectionism. Protectionism we didn't discuss. Let's discuss it later. 22. Another past paper. Let's look at it. Yeah. Question number 5. Usually they set question number 5 from international trade, right? Explain the terms of trade. Yesterday we discussed it. That's part 1. Explain the absolute advantage theory with an example. You can manage that. I discuss it. Step that taken to reduce negative impact of the devaluation of Sri Lankan rupee against US dollars. Right, see? Again, they are talking about the devaluation. Now, state 3 steps that taken to reduce the negative impact of the devaluation. Now, devaluation, you devalue currency, right? In this answer, they have devalued, right? But here they're asking what step you should take to reduce the negative impact. Now, we know with the devaluation, import prices increase. Then you have to reduce your imports, and import substitutes should be produced within the country. And with the devaluation, exports are demanded. Then you have to encourage, you have to facilitate exporters to increase their supply. Sometimes we give financial facilities, we encourage them. Other support should be given to the exporters to increase the export. So then you can reduce the impact, negative impact. And you have to manage inflation of the country, within the country. So likewise, we do certain things to reduce the burden of devaluation. Very good. Let's look at another question. 22 July. 22 July. Yes. Look, this part is very important. That's why I discussed this. Explain two reasons for recent devaluation of Sri Lankan rupees against US dollars. Advantages of international trade. Now, the whole question is easy. 23 January. 23 January question. Look, reasons for demand in dollars. Two reasons. Why do we demand for dollars? To make payment for imports and invest in other countries, to make payment or loans repayment or interest payment. Those are the reasons, right? Demand for dollars. Very easy. And absolute advantage, then comparative advantage, I'm not going to discuss. We have discussed it. Two types of transaction recorded in the balance of payment. That is the next part. We'll see the possibility to discuss this lesson. Right, quickly look at 23 July question. Question number 5, most probably. Balance of payment, argument against the protectionism. Again, you have the same question. Explain two economic effect of devaluation of Sri Lankan rupees against US dollar. Now see, learn this part, learn this concept. 24 January. Yes. Twenty-four impact of the trade barriers implemented Sri Lankan government. Disadvantages of currency depreciation of a country. Now it is depreciation. Depreciation, you can remember, that is also decrease in value, but it is not purposely decreasing. Now decrease in value as a result of increase in demand for currency and decrease in supply of currency. You have to explain that, even with the illustration. Right. Let's move on to the next part. Then learn exchange rate, devaluation, depreciation, fixed exchange rate system, and floating exchange rate system. Let's look at next important part, balance of payment. Balance of payment is the systematic record of international trade. Right. Here, page number of your study text. Page number 172, 173. 172, give me 1 second. Right. Basically, all international transactions are recorded. The transaction of a particular year are recorded in the balance of payment. We call BOP. BOP consists of two main accounts, current account and capital account, and financial account. Right? Here, balance of payment, the sub accounts are given current account and capital account, then financial account. In each account, different transactions are recorded. But at the very beginning, when you record the transaction in balance of payment, we apply double entry accounting principle. You know double entry accounting principle. in your transaction, you have dual aspect. One entry is debited, the other other entry is credited. Right? Let's say you purchase, you sell goods. How do you record the transaction in your cash book? One record goes to cash book, the other one goes to a sales account, simply. Same way, when you export, right? When you export goods to another country, that record, that export income is recorded at two different places in the balance of payment. One is recorded in the trade account, one entry, and the other entry goes to financial account. Financial account, when you receive cash, foreign currency, that is recorded in the financial account. The other record in the trading account. Let's say you receive factor income, or you make payment to foreigners on, let's say, dividend payment, right? Dividend. When you pay dividends, how to record? One entry is recorded in the income account, the other one records in the financial account. So likewise, double entry principle is applied to record the transaction in the balance of payment. I don't think that recording mechanism would be tested, but just learn it. Especially, what are the sub accounts included in the balance of payment? What are the main accounts? Mainly, we divide them into current account and capital account. The other one is financial account. Especially, you pay attention on current account, right? We don't have time to explain this one much, but current transactions are related to, how do I say it? GDP, national production. The transaction which are taken place in between a country with the rest of the world and which affect national income or the total consumption of the economy are recorded in the current account. I don't think that you understood it. The current nature, so you can simply at this level, you can memorize and remember the items you include in the current account and capital account, the financial account. But there is a reason behind, the logic behind the transaction you record in the current account and the capital account and financial account. Especially in current account or the transaction. What are the sub accounts? Trade account, service account, income account, current transfer account, right? Now, those four transactions are directly relevant for the national income or the total consumption of the economy, right? That's why they are categorized as current transactions. Then foreign aids, foreign direct investment, and migration payments. So those are recorded in the capital account and the financial account, right? Please go through what are the transactions you record in the balance of payment, main sub accounts, and the transactions. Right. Let's quickly look at protectionism. I don't think that that part is hard. International trade, when goods and services are imported to a country, local producers have to compete with them. Then there is an impact, right? Though we import goods from other countries, our local industries and local producers, their profitability, their employment, and their income, their demand are affected by foreign goods. So therefore, countries apply certain protection tools. Even these days, we talk about like shortage of goods in the country, but we can put more tax and tariff on the imports. Then local producers are protected. even when taxes are imposed, importers have to pay tax and add tax to the price and sell them at a higher price. What is the advantage to the local producers? Local producers can sell the product at the same price, but they don't spend that much money because tax is not paid by them, right? International tax relating to the imports, right? Import duty, because they are not importing goods, but sometimes they import materials from other countries, but local producers are protected with those measures, right? Please read page number 175 of the study text, advantages and disadvantages. Other than that, of course, I discuss all main areas, go through past questions and the answers as well. I don't think you have a hard question paper even this time. All questions are taken from the study text, but don't disregard your teachers' lecture materials. Please read them, but don't forget to study the study text, right? If you have any questions or the unclear ones, I will share my contact details. One second. Okay. Right. This is my contact details. You can email me or you can call me. It's my number. Right. Thank you very much and good luck. I'm sure you all can get good marks this time. Thank you.